time which is considered to analyze your profitability. So it requires that a balance sheet and a P&L should be prepared within this time period. So the time period could be anything which we will learn in the subsequent accounting concept. So it means that you need to analyze your profitability based on these two parameters, which is one is your profitability and your financial strength, which is shown in the balance sheet, and that needs to be analyzed for this particular time period. Now, generally, this time period is considered to be 1 year, that is a period of 12 months. So if you look at the companies which are operating world over, when they talk about this accounting period, they specifically talk about something known as a financial year. So what we mean by the accounting period is, in other words, a period which covers your reporting perspective. But as of now, we consider this accounting period to be 1 financial year. But it need not be, because the next concept will let us know how this accounting period could be further divided. So a financial year means a period which covers 12 months or lesser than that, preferably 12 months. But this 12 months period where you will start accumulating your income and expenses for that particular period. What is the significance about this concept? So it helps you to predicting the future prospects of the business. Why? You are trying to analyze the profitability of your business for the completed financial year. This profitability will let you know how the business is going to be in the future, with all uncertainties subject to that, because we don't know what is going to happen. Say, for example, now if you look at the last year and the current year from a Sri Lankan perspective, the businesses have not done well due to two main reasons. One, the Easter Sunday attacks that happened last year, and the COVID-19. So as of now, you know, somebody who would have performed exceptionally well in 2018 might have still come across a difficulty in these two time periods. So the financial reports are just an indication. It's not the perfect prediction of what is going to happen. No, it is just a projection of what it could be, subject to all abnormalities or extraordinary items that could happen on in the environment, business environment. Further, it also helps in calculating your tax on business income. So, as you know, if you are a corporate, then you have to pay taxes. Like the individual, you have to, if you are running a business, you have to pay taxes. Now, these taxes are paid on a continuous basis. As a result, in order to demarcate the tax payments, what the Inland Revenue Department has done is, like the accounting period or the financial year for which you consider your profitability, the Inland Revenue Department also has defined a period which also relates to your tax. So in Sri Lanka, the tax period is normally from 1st of April to 31st March of next year. But the accounting taxes will be calculated based on the financial accounting period of the company. So some companies might have a financial accounting period which starts from 1st of April to 31st March, which means they are in line with the tax year. But there are certain companies, mostly the banks, which starts from 1st of January and they go until 31st December, the 12-month period. But their taxes have to be paid based on the tax year, that is from 1st of April to 31st March of next year. It also helps the business firms to distribute their income at regular intervals. Now, this is very important. As a company who has several shareholders or maybe the stakeholders, there are instances where you might have to distribute your profits to these shareholders, not to the stakeholders, but to the shareholders. Now, shareholders will look for a continuous return from their investment that they have put in. As a result, the company has an obligation to pay a dividend, which is your distribution, for the shareholder from the profits that you earn. Why? They have given you money, or in other words, they have invested money in your company for you to run the business, make profits, and redistribute certain portion to them. Now, this expectation is always there. That is why this principal-agent relationship is there. There is a set of people who will act as agents of these principals, and they will manage the business, and they will reproduce a return to these principals. Now, the problem is you have to have a cutoff point for this distribution. Otherwise, what will happen? The shareholders might expect each and every time you talk about your profitability for them to have something in return. So as a result, the companies demarcate this payment of dividend in terms of their financial year. So you ascertain your profitability for the entire financial year, and then you decide what is the proportion that I'm going to pay as dividend to these shareholders. So in other words, this accounting period concept also helps a company to determine what is the interval, time interval that I should pay dividend to my shareholders. Now, joining with this, I took the periodicity concept. The periodicity concept says that an organization can report its financial results within certain designated time periods. Now, we have been talking about accounting period concept. Now we are talking about certain time periods within this accounting period. This typically means that an entity consistently reports results on a monthly, quarterly, or annual basis. Now, here comes an additional reporting framework for you in order to monitor and manage your performances. Now, when it comes to the annual reporting, or in other words, reporting to your shareholders and stakeholders, you normally do it on an annual basis. Or in other words, now in the current context, we do it on a quarterly basis also. But in order for you to present those results, your company or management should know how the company is progressing. So as a result, the company may decide some additional time periods which also will help the company to look at your performances. Now, I can demonstrate this with a diagram which is not in your presentation slides. I just added subsequently. So we look at this accounting period, which is for 12 months, starting from Jan to December, or maybe according to the financial year of the company, it may run into certain. Now, for example, I can take, if you look at the Australian companies, they start from July and they end in June. Okay, so, but in Sri Lanka, mostly the companies are Jan to December or April to March of next year. Now, this monthly reporting is also very important because the management needs to know to align their business decisions in line with their performances. If the performance is deviating from the estimated, which is we call it as the budget, then you have to align your performance in line with the budget. Due to this factor, what the companies will do is they expect from the reporting people for them to report their financial performances on a monthly basis. So the most frequent reporting time period that happens in a company is the monthly reporting, which we normally call as the board papers that are submitted to the board of directors. So the most immediate and frequent reporting time period will be the monthly reporting. In addition to that, the company might also look at certain management information reporting, which could happen on a daily basis or even could at a weekly or fortnightly. So those time periods I'm not discussing because that is an organization, internal organization's decision for them to decide what to be reported at what time frame. But this is something very important, the monthly reporting, for the board of directors to make their decisions. Now, stemming from these monthly time brackets, when you group them into 3 by 3, we get 4 quarters, 4 quarters. Now, the regulators for any company, say for example, it could be the central bank, or it could be the Colombo Stock Exchange, or the Security Exchange Commission, any authoritative bodies might require financial information to be made available to the public. Now, especially in the case of banks, we have an obligation because we are dealing with public money. As a result, the central bank is very strict on the reporting to the public. So the central bank as well as the stock exchange insists on interim financial reporting, which is known as the quarterly financial reporting. So that is what the first set of regulatory reporting that will happen. But in addition, those I don't know how many of you all know, for banks specifically, the banks are required to report to the bank supervision department of central bank on a monthly basis. So likewise, you do your performance reporting to the management, you also need to do a reporting to the central bank on a monthly basis. That we call it as a regulatory reporting. But the quarterly reporting is specifically for the public, or in other words, your stakeholders. So stakeholders can obtain information, financial information from a company only at interim intervals, because they cannot be going and asking from the company each and every time they want information as and when they require. No, that is not permitted, because that will interrupt the business processes of the company. As a result, the stakeholders are permitted to obtain financial information which is published on a quarterly basis. Now, adding to these 4 quarters, now we bring in another time period which is known as the annual time period. So the annual time period is where the companies do financial reporting covering the 12 months period, a period of 12 months. So this is where the companies will publish a document called annual report to the stakeholders, especially addressed to the shareholders. And this annual report becomes a very important marketing tool when it comes for accounting information of a company as well as financial and non-financial. Because in good old days, the annual report was focusing on financial information only. But if you look at it today, it has a lot of non-financial information. So the annual report of a company is now has become one of the biggest and most important marketing tool that is available to a company. So what is the significance of this periodicity concept? Dividing up business activities into artificial time periods, which is the general monthly periods, allows users to have financial information at regular intervals. It also provides an opportunity to predict future business performance. So as I told you, if you have not performed well in this quarter, then it gives you an opportunity to align your performances in the next quarter so that you can catch up the deviations if possible. Okay, so that is all about the periodicity concept. So we have covered the accounting rules, right? We have come up to the periodicity concept. Now let us look at another concept which is also very important, which we call it as the accounting cost concept. Accounting cost concept. Now the accounting cost concept states that all assets are recorded in the books of accounts at their purchase price, which includes cost of acquisition, transportation, and installation, and not at its market price. Now this definition might look like very technical, but let me put it in a simple example. Now you know what is an asset is. Asset is anything that you own in your business, and it is a result of past transactions. Now, our duty is to record the impact of this transaction in my records, or books of accounts means your accounting records. Now, how do I ascertain the value of this asset into my books of accounts? That is what this accounting concept means. Now, let me give you a simple example. Let us say that you are, I'll just take an example of a branded company so that it makes us very easy to understand. Let us say the company which is highly talked about, the Brandix. Let's take the Brandix. So the Brandix is an apparel company. You know, that is an apparel company. So they are heavily dependent on these high cost machineries which they use to produce the apparels. Now let us assume that the Brandix is trying to purchase a machinery for their manufacturing purposes. Now this machine is going to come from, let's say, Germany. So the high quality, high tech machinery is available only in Germany. So the company is now trying to get down this machinery to their warehouse, or in other words, their manufacturing warehouse. So how it will happen? They will go and request this foreign supplier to send them a machinery for whatever the value that they agree upon. So there would have been some negotiation, and the two companies would have agreed for a price. So let's say the price that they agree will be your purchase price. Okay. So the company, the local company, as with the foreign company, they agree on a price. Let's say this machinery is valued at 15 million. Okay, 15. Okay. So that is that much of a high value machine. Now this machine will be exported from this from the country of Germany. So it has to come through the vessel, and then it will land in the Hambantota or maybe the Colombo port. And from the Colombo port, it has to be taken to the manufacturing warehouse of the apparel company. So you will see, when this particular machinery is exported from Germany, then it has to go through a process of phase which is through the sea. Now, when you are traveling through the sea or transporting through the sea, there is a risk always. So the company doesn't want to take any risk when it comes to transporting this machinery, because it's a high value machine. So what they would do is they will look for a insurance in order to look after their safety with regard to transporting this machine. So let's say this cost of insurance of transporting the machine from Germany to the Sri Lankan port will have a value, and that needs to be borne by this apparel company. Let's say that is about 5 million. Just for example, I'm taking some numbers. So the insurance cost is now 5 million. The machine is 15 million, insurance cost is 5 million. Now the machinery has landed at the port of Colombo, let's say, and now that has to be taken from there to Minuwangoda. So again, you will involve a transportation which will be mostly through containers, and it should be on our roads. Again, you will have another insurance aspect coming into this, because the safety is very important when it comes to transportation of a high value machine of this kind. Then let's say that is about 1 million. You will transport the machine, and it has now reached the warehouse, manufacturing warehouse of the apparel company. Now, just because the machine has come, it is not a plug and play machine when it comes to these kind of businesses. So the next part of the machinery would be the installation and startup running the machine. Now the installation might not be possible. Maybe I'm just taking an example, to do it within the in-house technicians. Sometimes you might have to get down consultants from Germany in order to start the installation of this machine. So your consultation fee for this purpose, let's say another 1.5 million, because this is a high value activity. So they are traveling, accommodation, everything will cover about 1.5 million. So they have come down and the installation is now done. So if you look at it, the machine was only 15 million for all purposes. But now, in order to start using this machine, in between, you had to incur several expenses. First, you had to incur an insurance of 5 million through the sea transport. Then another 1 million for the on-road transport. Then another 1.5 million for the installation. All these have been paid from the business, not from private money. So as a result, now the question comes, what is the value of this machine that I am going to take in? Value of the machine was actually 15 million, which is, we'll say, the market price or maybe the price that you have paid. But when it comes to accounting perspective, we will not record it at 15 million. You will have to add up all the subsequent expenses that you have incurred in order to make the asset to be start using. So you started with 15 million, you added another 5 million, which is the insurance, then again a 1 million for the land transportation insurance, and another 1.5 million for the installation. So altogether, now you have spent about 22.5 million for this machine before you start producing apparel out of this machine. So as a result, your company books will show, the accounting records will show that this machine is worth 22.5 million instead of the 15 million, the purchase price. Now, from where do you get this accounting principle? That is from the accounting cost concept. I think it had been a long example, but this is what the underlying principle of this accounting cost concept, which means that all assets are recorded in the books of accounts at their purchase price, which includes cost of acquisition, that is the price that you buy, transportation, and installation. Now, this is just an example, but let us look at a building construction. Now, if you are constructing a building, before that, let's assume there was a building in that particular land, then you will go and demolish that land, building, and then only you have to start constructing. So the cost that you might pay to demolish the existing building will be also part of your cost of the building construction that you are doing. So it is very important that you need to understand this accounting cost concept, because it will lead to a lot of implication when it comes to taking expenses into your books. Okay. What is the significance? This concept requires asset to be shown at their price it has been acquired, which can be verified from the supporting documents. So you know, when you accumulate the cost of an asset, you need to have the individual components of that asset, which means the price that you paid initially, for which you have to have an invoice. Then you will have to pay paid insurance, for that you have to have an invoice. So likewise, you have a lot of documents which relate to the cost of the asset. It also helps in calculating the depreciation on fixed assets. So you will have a clear value of which you have to depreciate your fixed asset. The effect of cost concept is that if the business entity does not pay anything for an asset, this item will not be shown in the books of accounts. Very simple. If you get something freely, which means you will not show anything because you haven't paid anything for that asset. Okay, so that is what it means. As long as the accounting cost concept is there, you will have to recognize a value in the books of accounts. In the books of accounts. Now we get on to the accounting convention. So the accounting rules are done. Now we look at accounting conventions. under which the first accounting convention would be the materiality concept. The materiality concept. The materiality concept states that financial information is material to the financial statements if it would change the opinion or view of a reasonable person. Now we know why we are preparing financial statements. That is for your stakeholders to understand the performance of the company and also its statement of affairs, that is the financial position of the company. Now when it comes to this, it has to be a person who can reasonably understand what the company says or what the company's performance is. Now, based on this financial information, the person should be in a position to make a decision. But if there is any information which could change the opinion or view of a person, then that piece of information will be considered as material. Okay. So any material information that could have an impact on the reader or maybe the investor to make their decision otherwise will be considered as a material piece of information. And from where do you get that? It is from the materiality concept. Materiality concept. Now let us assume an example. The company has made a financial loss during the financial year due to a fraud. Let's say there is a fraud in the company, and due to that fraud, there is a financial loss. Now, this financial loss, the company doesn't want to disclose because it is not good for their name, so they don't want to disclose this loss. So what they do is they bring in that piece of information in a different manner. They show it as an expense, let's say. Now, this piece of information will be very vital for a person who is investing in this company. Because if there is a tendency of happening financial frauds like this, then there is a huge risk in terms of the investment of the investor. Because they don't want to invest money in a company which is having financial frauds. So that piece of information will be considered very material as far as the reader or the investor is concerned. So it is very important that you need to show any material information in your financial statement, which additional information. Now this additional piece of information is also known as disclosures. I think that is the last concept in this chapter, so which we will look at there. So if there is a loss of any kind, or maybe there is a special kind of a transaction, then you need to disclose that piece of information in your financial statements. So that when a reader reads the financial statements or understands the financial statements, this additional piece of information which is considered as material will be useful for that person to make decisions. So it is the responsibility of the company as well as the preparers of financial information to make themselves understand that they do not avoid any material piece of information in their financial report. What is the significance? The concept is relative in size and importance. So there are two sides to this particular concept. What is material? Because sometimes what will happen, 5 million for some company may be very important. But for some other company, this 5 million number would be very small. So that is where the materiality comes into play in terms of size. But the previous example that I disclosed, the financial fraud. Now the financial fraud is very important because it can lead to many other consequences to the company. So an item could be in terms of size and also in terms of importance. So the materiality concept is driven with these two aspects. One is the size or the value of the transaction. Secondly, the importance of the transaction, whether it will have an impact on the reader. Most of the time, financial information materiality is judged on qualitative and quantitative characteristics. So I told you one is size, the other is importance. So the size is the quantitative aspect. When it comes to the importance, that could be your qualitative aspect. So qualitative means where it doesn't involve any values. Quantitative means where it talks about values. So the materiality concept will be twofold. One is a qualitative aspect as well as a quantitative aspect. The next concept would be the prudence concept. So as you know, we always look at concepts which are driving the financial performances of companies. So in terms of prudence means how you perform your business. The rationale behind prudence is that the company should not recognize an asset at a value that is higher than the amount which is expected to be recovered from its sale or use. Okay. Now, I will go back to the same example, which is the machine that was purchased for the company. So, if you look at it, why this company has purchased a machine is to produce apparel. Okay. Now we know that this machinery was 22.5 million. Okay. Now, when they start using the machine, the expected output of this could be somewhere close to this value. Or in other words, we say after using this machine for a certain period of time, we are not expecting to sell this machine and get 25 million. Okay. So what it means, we do not expect to recover 25 million or what is something more than 22.5 million from the sale of this machine after using it for a certain period of time. That is called prudence. Now that is one side of the story. That is how you look at it from the assets perspective. But let us look at the liability perspective also. The liabilities of an entity should not be presented below the amount that is likely to be paid in its respect in the future. Very straightforward concept. Suppose you have a liability. Liability means an obligation. So let's say you have an electricity bill to be paid next month, which is 15,000. So what is your liability? Your liability will be 15,000. Now, since you are short of your profits, what you do? You book your liability as 5,000. But actually speaking, your liability is 15,000. Now, this prudence concept doesn't allow you to book this 5,000 because it says liabilities of an entity should not be presented below the amount that is likely to be paid. So if you know that you are supposed to pay 15,000, then you can't recognize a liability which is 5,000. That becomes very absurd in terms of financial reporting. So as a result, what it means is you should not record any asset where the value of the asset that you are booking should not be more than the value that you expect to recover. Conversely, you should not book any liability which is less than the amount that you are expected to pay. This is very important concept as far as the financial reporting is concerned. Because when it comes to financial reporting, it is very important for the people to understand what is prudence. So basically the prudence is in terms of assets and liabilities we look at it. But the corresponding impact of same is in your profitability. Because when you recognize an asset which is high in value, means you are trying to avoid certain expenses which needs to be charged to your P&L. Conversely, when you are understating your liability means, that is also again going to understate your expenses. Because what will happen? You will have to show an expense of 15,000 in your P&L, and that will be booked as a liability in your balance sheet. But when it comes to, just give me 1 second. Yes, come in. Yes, come in. Okay. Sorry for the interruption. I just got a notice from the institute that is next week we will not be having any classes due to the Christmas festive season. So please make a note, the online session lessons would not be held the coming week. Okay, right. So as far as a financial reporting person is concerned, it is very important for us to know that you should not understate your assets. Yes, you should not overstate your assets. Similarly, you should not understate your liabilities. Okay, so the impact of which I have explained now. When you overstate your assets means you are undermining your expenses. Similarly, when you are understating your liabilities means that is also you are undermining your expenses. So when you are undermining your expenses means obviously you are trying to show a high profitability. This is where financial reporting personnel are criticized for as manipulation. You can manipulate your financial statements by doing this. That's why this concept is there, for people to understand the importance of prudence so that they will not try to hide the expenses which they need to consider. What is the significance? There is an inherent risk that assets and income of an entity are more likely to be overstated than understated by the management, as I explained to you. Whereas liabilities and expenses are more likely to be understated, very obvious. So these two aspects have to be very important when it comes to the application of the prudence concept. The next accounting convention will be the timeliness concept. Timeliness. So by the name itself, you know what it is. Refers to the need for accounting information to be presented to the users in time to fulfill their decision making. Very straightforward. That is, you need to provide the financial information when it is required, not when the reader doesn't require it. So, for example, I'll take you through to this. Yes. Now let's look at this example. Now you know, if you are to prepare monthly financial statements, let's say January. So the January financial information that is on January 31st is the cutoff point. So now you need to prepare your financial statements in the month of February and provide it to your management at least by the mid of February. If you try to produce the financial statement somewhere in March for the month of January, it doesn't make any sense. Why? By that time, you have completed February also. You see? So it is very important that when you submit your financial information to the reader, say if you are doing a monthly financial reporting, so at the end of the month, from that date, at least within 15 days, you should be in a position to produce your financial statement. Now look at what is going to happen in a quarterly financial reporting perspective. Now you are trying to report your financial information for the period of first quarter, which is January, February, and March. Now, where do you draw the line? The financial reporting for this should happen at least in the mid of this quarter. At least in the mid of this quarter. If you are going to do this in the third quarter, then there is no point. Why? By that time, the second quarter is also done. So it is very important for us to understand when we are supposed to do the financial reporting to meet the timeliness aspect. As a result, let me add this also for this purpose. When it comes to the regulatory reporting, the central bank has insisted that, especially the banks, they are regulating the banks and finance companies, the monthly reporting of banks should reach on no before 15th of the subsequent month. So likewise, you know, the banks are compelled to do the financial reporting on a monthly basis just before the 15th of every month pertaining to the previous month. Similarly, when it comes to a quarter, they have to do it in the middle of the quarter, means before May 15th of every year, your financial reporting for quarter one should happen. Before August 15th of every year, quarter two should happen. Before November 15th of every year, quarter three should happen. And what will happen for the quarter four? It will go to the next year. So next year, what will happen? It should be ideally before February 15th. But here there is an exception, because when you reach your fourth quarter means that is your financial year. So when your financial year is done, you know that the financial statements require to be audited. You have to provide your financial statements to an auditor and get it vetted by this auditor. So as a result, when it comes to the quarter, you are allowed an additional time period. It's not within, in earlier cases, you will see that is within like 45 days. When you take quarter one, before May 15 means 30 days plus 15 means 45 days. And again, quarter two, August 15 means 31 plus 15, again 46 days. Likewise, when it comes to the last quarter, it is not within 45 days, but within 60 days. But for other regulated reporting, we will have more time period when it comes to the year-end financial reporting. Now, what do you mean by all these? That is this timeliness concept. The company should do the financial reporting on a timely basis. Otherwise, it will not be useful for the people who are making decisions. Significance. Timeliness of accounting information is highly desirable, since information that is presented timely is generally more relevant to the users, while conversely, delay in provision of information tends to render it is less relevant to the decision maker. So for the decision maker to make their decisions on a timely manner, you need to provide the financial information on a timely manner. This is what the underlying concept is. Full disclosure. So I mentioned about this at a previous concept, which is the concept which states that a company must disclose all the information that would affect the reader's understanding of the company statement. Now, if you look at today's financial statements, they have become more and more complex compared to what we had maybe about 10-15 years back. What is it today now is very complicated. So as a result, the amount of people or the number of people who will read these financial statements and understand also have become very less, because the technicality has been too much now. Because new standards have come in, accounting standards have come in, those have created more and more problems for the accountants. So as a result, now the financial information is very complex for the reader to understand. So when such a situation happens, it is the responsibility of the financial reporting person to make the reader understand more. So you need to provide them with additional information, which we call it as disclosures. And these disclosures are a must now for a reader. So it is very important for a company to provide all such disclosures which are required by the standard as well as by the central bank for when it comes to the banks, to provide all the disclosures that are coming under your financial reporting framework. What is the significance? Information that must be disclosed includes knowledge of future events that are likely to happen and will have a significant impact on the company's finances. Very obvious. If the company is expecting to declare a dividend in the next 2-3 months, that has to be disclosed to the public or to the shareholders. Why? The distribution of dividend will have an impact on the company's cash flows. I told you, when you have a dividend payment, that is a cash outflow, cash going out. When the cash goes out, that has a direct impact on the company's finances. So the shareholder must be made aware in advance what is going to happen in the future. Say, for example, if the company is expecting to borrow money in the future, that also needs to be disclosed. How we are going to borrow this money and how the borrowing will take place, at what interest rate, all these are very important for an investor or a decision maker. Users of financial information become more informed to make better decisions. So when you give more and more disclosures, the user of the financial information becomes more informed, because one of the fundamental responsibility of a company is to keep your stakeholders informed about your company. So as a result, the full disclosure concept is also very important when it comes to financial reporting. So that brings us to the end of accounting assumptions, where we went through concepts and certain assumptions, everything. So if you have any questions, please feel free to raise that so that I can answer before we move on to the next chapter. Okay, so we will move on to the next topic, which is also the beginning, the introductory point of accounting. So as I told you, some of you might have already done accounting for your maybe A levels, O levels, and maybe the subsequent academics. But there could be an audience which where they would have not done any accounting, so I need to take them also with my journey. So as a result, I will start, as I told you, with the basics, and then we will gradually start accelerating. So you all should be in par with those who know the subject, but it's better just for your understanding, revise what we have been doing. So let's get on with the next chapter. which is the accounting process, and chapter 4. I hope this handout is already available on the portal. And let us start with that topic. Okay. So the next topic will be the accounting process. So let us start with what are the categories in accounting. So basically, accounting has three branches. Accounting has three branches. We normally call it as financial accounting, management accounting, and cost accounting. So what do you mean by financial accounting is where you provide historical financial information about an organization. Historical financial information about an organization. So why it is historical information? Now we know that our financial reporting is done at the end of a particular period. So at the end of a particular period means you are looking at what has already happened, not about the future. So when you are looking back at what happened means that obviously becomes history. That obviously becomes history. So it is very clear that the financial accounting framework is always looking at historical information. But this historical information only will not be sufficient for you to make decisions. Therefore, you need to have another arm which can help you to look at the future. That is where we talk about management accounting. Management accounting means where it provides the information for internal planning, decision making, and controlling purposes. So this is very important when it comes to manufacturing organization. Manufacturing organization means where you manufacture a product and then you sell it. Like apparel companies, I can name few, Damro or maybe Singer. Likewise, those companies, they manufacture products and then they put it to the market. So those companies, in addition to the financial accounting information, they need management accounting information. And when it comes to the management accounting information, you need to go into details where it comes into the cost accounting framework, where cost accounting provides you the cost details of your goods and services. So you go into the nitty-gritties of the manufacturing cost involved in producing your goods and services. What are the raw materials? What are the process costs that would have been involved? So you will go into very minute details of your manufacturing process, which takes you to the cost accounting framework. So as far as the accounting framework is concerned, we talk about these three main branches: financial accounting, management accounting, and cost accounting. Financial accounting talks about your historical information. Management accounting talks about your present and future information for internal planning and decision making, and also cost accounting, which provides you the details of your cost details of your goods and services. Why it is important? Because accounting acts as a social phenomenon. Because we call that as a phenomenon, investors are keen to invest more and more in profitable ventures. That is very straightforward thing that we know. Who is very keen in investing in a company? That is a person who thinks that these are very profitable. Now, for example, if you are trading in shares in the stock market, you will know which share you will buy, the share that will going to go up in price. You are not going to buy a share which is going to go down in price, because it doesn't make sense. So it is very important that accounting acts as a social phenomenon, because the investors look for more and more profitable businesses. Secondly, it acts as a source of information. Now, accounting helps to provide the important information not only to the third parties but also to the management that we have already gone through. There will be a set of reporting which is happening to the public, and there is a set of reporting which happens to the internal management. So people know that what needs to be reported to the internal management and what needs to be reported to the public. So as a result, it becomes a source of information for the readers as well as decision makers. For the readers as well as the decision makers. Thirdly, it is a mean of control. It is a mean of control. What do you mean by control? Now, it provides information relating to your income, expense, assets, and liabilities that we already see. Why these are important? For the management to know what is the level of income that they are generating, how far their expenses have increased, what are the assets that they have, what are the liabilities that they have to meet. You see, a lot of information is there when it comes to financial reporting. When you look at all these, you can next look at how to direct and control these resources. Whether your staff expenses are more, whether your income levels have gone down, what should I do to increase them? How do I bring my expenses down? How do I manage my assets? How do I pay my liabilities, where I should borrow or not? So a lot of decisions have to be made. A lot of control measures have to be taken. So the financial accounting also becomes, or in other words, the accounting also becomes as a mean of control. So the accounting process starts with where you record the transactions. You consider the transactions as well as the event. We will discuss what the transaction and what the events are. So you look at the input, which is your transaction in events, and then you process. Now you have received a certain set of information and you will process them. And then you produce the output, which is your financial statement. So just like a computer, the computer takes in information, processes it, and then it produces a result. Likewise, the accounting process is also same, where you have an input, then there is a process, and then the result is the financial statements that you produce. Now we look at what are transactions and what are events. Business activities can be described in terms of transactions, both external and internal, and can be measured in monetary terms. So that is rupees and cents or dollars, whatever. So business activities can be described in terms of transactions. These transactions can be internal as well as external. And also you might have events, which is again both internal and external. And these events are known as occurrences that may result in changes in value and quantity of assets, capital, and liability. So there could be events which take place and it will result in a change in your assets, capital, and liabilities. We will look at those, what it could be. External transactions are exchanges of values between two entities which yield changes in the accounting equation. So I told you, when you say two entities, it need not be always two companies. It could be two parties, two individuals, anybody. So external transactions mean where you will exchange values between two parties. And that will have an impact in the accounting equation. Now, you should be remembering what is the accounting equation is. So when you enter into an external transaction, there will be obviously an impact in the accounting equation. Internal transactions are exchanges within an entity. They can also affect the accounting equation. So this is something, a transaction which is happening internally within the company. Even that can have an impact on your accounting equation. Okay, say for example, you are a bank and having branches. Now, what is the main objective? Bank branches are expected to provide service to the outside. So that is all your external transactions. But there can be transactions which are happening between the branches also. I don't need to explain it because you all must be knowing already. There could be transactions between the branches. So those are internal transactions, but still those transactions are also have an impact on the accounting equation of the company. And events refer to happenings that affect the company's accounting equation, which cannot be reliably measured. Say, for example, a company is expecting an event to take place in future, which is raising share capital for the company. So you are expecting to inform your shareholders to buy your shares in the future because you need more capital. Now, until the people buy your shares, the new shares that you are going to issue, you don't know how much the value could be. But this is an event which is going to have an impact in your accounting equation. Why? When you issue shares, your capital will go up. Similarly, when you receive money, your assets will go up. So the accounting equation has an impact. But the value of which is not reliably measured at this point in time. But the event is very important and it needs to be disclosed to the public. So when you are, if you have a time, just go through the financial statements that are published by the companies, banks especially, on a quarterly basis. You can see now we are in the fourth quarter, but third quarter financial results are already published. So you can go and have a look at those in the websites or maybe in the newspapers. There you will see these. The companies will give their financial information, and on the disclosures or additional notes, they will have these events that are expected to happen in the future. So those will give you an idea about what these events means. Events mean the happenings that could have an impact on the accounting equation of the company. So then we go on to the accounting cycle. The accounting cycle means how the accounting transactions, starting from the transactions, how it goes through a process until you report your financial statements. Okay, so starting from the company's operation, you will identify the transaction and events, classify the transaction and events, then you will record in the primary books. The primary books is the next topic that we are supposed to learn. Then you will account for the transactions. Then you will extract a trial balance. Obviously, we are going to learn all these, so you don't have to worry. The trial balance is a separate topic in our module. Then you will have an adjusted trial balance, which we will be learning and which is part of your question number 1. And then you will prepare the financial statements, post closing adjustments, and taking balances to the next year. So this is what known as an accounting cycle, because this is continuously happening. There is no break in it. Continuously you are going to do it on when as far as the business is concerned. So that is why we say the company is a going concern, because you operate, identify transactions, classify them, record them, accounting for them, extract your trial balance, adjust your trial balance, prepare financial statement, post closing adjustment, and then you get on to the next year. Okay. The most important topic, the double entry system. So business transactions have a twofold aspect. We call it as a twofold aspect. What is the twofold? There are names given for this, which we know as debit and a credit. So all transactions from this point onwards, we will be talking using the terms debit and a credit. Some of you might already know who have already done this, but there may be people who might not know also. So I have to go through this phase where the transactions are named as either debits or credits. So hereinafter, when we talk about transactions, we always have to think about what are the transactions which could be classified as debits, what are the transactions that could be classified as credits. Very important. A system of accounting where both aspects of each transaction are recorded as per prescribed rules is called a double entry system. So in examination, you might be asked to write what is a double entry system. So what do you mean by a double entry system is a system of accounting where both aspects of each transaction, what are the both aspects, the debit and the credit, are recorded as per the prescribed rules is called a double entry system. Now you identify a transaction. When you have identified the transaction, then you have to mark them as what is going to be debited and what is going to be credited. So when you mark those two, that will be your double entry system. Following the double entry system keeps the accounting equation in balance at all the time. So one of the key principles in double entry system is to ensure that the accounting equation is always in balance. What is the accounting equation? Assets equals liabilities plus equity. So when you apply the double entry, it always will be assets equals liabilities plus equity. It cannot change. If you have failed to adopt the double entry system, then the equation will not balance. That is what it means. Now we get on to the basic form and account. So as of now, all of you might be having accounts in the banks, but we don't have a particular form in accounts. Our account will have a name, our account will have a number, and you will get a statement or a passbook, or some of you might be taking a transaction, looking at your transactions in your online platforms. So nowadays, we are not much bothered about what is the structure of an account. But for your academic purposes, as far as this financial reporting business accounting subject is concerned, we learn something about called as the basic form and account of an account. What is the basic form? This is the basic form. There will be always a title of the account. Title of the account is the name of the account. And this account will have a structure which is generally known as a T structure. You see this T structure is there. So when you have a T structure, what will happen? There is a left side and a right side. So obviously you are having an account which has two parts to it, and it will create a shape of a T, and this T will be known as a T account. We call it as a T account. Now every T account will have a title. Title means the name of the account. There will be a left side and a right side. Now why this left side and right side is important? That is what the two aspects or twofold aspects of an account. The left side is always known as debit or the debit side. The right side is known as the credit side or the credits. Okay. So now you need to remember that when we talk about an account, the left side of the account, when you write draw the structure of an account, it will be having a title of the account, and the left side is going to be known as a debit and the right side is known as credit. Now when you look at your account, your personal account, savings account, or maybe current account, whatever, you will have a balance, say 1,000 rupees, 5,000 rupees, or whatever. Now this balance, What is it generally? When you have a savings account, what is that balance is for you? That is we call it as a credit balance. We call it as a credit balance for you. Now, it is very important you define this balance from whose perspective. So when you are preparing financial statements, you always look at it from the company's point of view. Please remember, we always do financial reporting from the company's perspective, not from the other party. So as a result, when you are doing financial statements or accounts in the examination also, you have to always look at it from the point of view of the company for which the financial information is given, not from the parties or involved into the transactions. We always, let's say you are given a question saying that ABC company has the following transaction. So what is that means? Which means you have to look at all the transactions from the point of view of ABC company. So it is very important that when you draw a T account, the left side and the right side is always looked at from the point of view of the company. So when you have a balance on your left side means that is known as a debit balance. When you have a balance on the right side means that is known as a credit balance. So normally, please remember, you will not have a balance on both sides. That is wrong. You won't have a balance on this side as well as on this side. No, we don't call it like that. Account will have only one balance. Either it has to be a debit balance or a credit balance. So if the balance is on the left side, you call it as a debit balance. If the balance is on the right side, you call it as a credit balance. And as I told you, the alignment of these parts resemble the letter T, which is, I explained to you, that letter T, and therefore the account form is called as a T account. So here and after I would say, when I say T account means this. So in examination also you might have to draw up T accounts. There had been past paper questions where they wanted you to draw up the T accounts in more comprehensive manner, which we will learn. But the simplest structure of a T account is this, where you will have a title of the account on top of the horizontal bar, and the vertical bar divides the left side and the right side. So the account is an individual accounting record of increases and decreases in specific asset, liability, and owners' equity. An entity must have separate accounts for such items as cash, salaries, expense, account payable, and so on. So now we have learned what is an asset, what is a liability, and what is equity. Now we are going into details. When you look at a company, you might have thousands of assets, thousands of liabilities, hundreds of equity items. Now, for each and every item, you will have to open up an account. You will have to open up an account. Now, that is one side of the story. Now, let's look at it from a bank's perspective. How many customers do you have? Some banks say that they have 1 million customers or 2 million customers. Now, what do you mean by that? You have 1 million worth of individuals or companies who are doing transactions with you. In other words, what does it mean? At minimum, you will be having 1 million accounts created in your bank's computer systems. I don't see any company today, any bank maintaining records manually. Mostly all the banks will have computer systems to run their day-to-day operations. So your computer systems today have, which means at minimum 1 million accounts in your system. That is why you are saying I am having 1 million customers or 2 million customers. But it doesn't mean it is only 1 million accounts. That is the minimum, because if each customer has 2 accounts means you will have 1 million customers but 2 million accounts. Okay, so it is very important. Say for example, I would best prefer to use the known example of Dialog. Now, if you look at Dialog, they are closely to 4 million or 5 million customers, I think. But what does it mean? It means when you have 4 million customers means you have 4 million mobile numbers in this country. There are 4 million Dialog numbers being used in this country. It doesn't mean that only 4 million Dialog numbers are there, because some of them have 2-3 mobile numbers. So what does it mean? 4 million customers, but there are, I don't know whether it is subscribers or 4 million customers, but whatever it is, which means there are individual number of accounts for everybody. That is why you are getting a bill for each and every number. So Dialog is maintaining an account of all individuals for individually for each number, so that they can produce a bill for you to make payments every month. So an account is very important, and it is looked at from the point of view of the company, not from the point of view of the individual. So in its simplest form, an account will consist a title, a left side or a debit side, and a right side or a credit side. So a T account, when you are required to do a T account, you will know, you will put the T structure, and you will write the name of the account at the top, and you will put a debit side and a credit side, which indicates the debit and the credit. So basically, we will talk about 5 types of accounts. 5 types of accounts. When it comes to a company, you might have these 5 types of accounts. But what we are going to look at here is basically from the point of view of banks, because your examination is more driven with bank related transactions. So we will look at the types of accounts a bank would have. 1, you know now, you can have asset accounts. You can have liability accounts. You can have capital accounts, or which means equity accounts. You can have income. You can have expense. So these are the basically the 5 types of accounts that you will normally have. Okay, you will have an asset account, liability account, capital account, income account, and expense account. But when it comes to bank, in addition to these, there is another type of account which is also maintained in the banks, which we call it as contingent liability accounts. Contingent liability accounts. That is, for the transaction that you record, which may materialize in the future. Because all transactions which have a predetermined monetary value are these 5 accounts. But there are accounts which are maintained by companies for transactions which could materialize in the future. What are these? Now, for example, banks will know you have an instrument called LCs, or letter of credit. Now, why you open LCs for customers? That is to import any specific items, vehicles, or any goods that they want to import. So at the point of entering into a transaction of opening an LC, you have agreed with the customer for a future liability, which may materialize in the future. Now that liability is known as a contingent liability. A contingent liability. A liability which is certain is called a liability, will be recorded in the liability account. A liability which is not certain, which can happen or may not happen, is known as a contingent liability. So please make a note, if you're having a notebook with you, that in addition to these 5 accounts, 5 types of accounts, a company, especially in the case of a bank, will have an additional type of account which is known as contingent accounts. Contingent accounts. Now we have looked at accounts and we have looked at balances. So if the balance is on the left side, you know that's a debit balance. If it is on the right side, you will have a credit balance. But it is very important for us to know what is the normal balance of an account? Now, when you look at an account, if the balance of that account is expected to be a debit, then that is the normal balance. If you expect this account to have a credit balance, that is called the normal balance of this account. Now, let's say you have a savings account with the bank. Generally, what is the type of balance that you expect to be in your account? We call it as a credit balance, because if you have a credit balance only in your savings account, you can withdraw the money. So as long as the balance is in credit, you can start withdrawing your money. The point that you reach zero means you don't have a withdrawal option. Okay, so if you look at a savings account or a fixed deposit, all those balances will be generally a credit. And that is known as a normal balance. So when I ask what is the deposit balance, you will say 1,000 rupees a credit balance or 10,000 rupees credit balance. But there are instances where it could go into debit also. So people or individuals or companies which are having current accounts with the banks have this option. When you have a current account in the bank allows you to have a credit balance or a debit balance. Where you have a credit balance means as long as you have a credit balance, you will withdraw money to that extent. But the moment you go into debit in your account, current account, we call it as a overdraft. The name given for that such kind of an account is known as an overdraft. So what do you mean by that? If I have an overdraft facility with the bank means where I can go and debit my account even if I don't have money. Even if I don't have money. What does it mean? I have to pay it subsequently. I have to pay it subsequently. But when it comes to the savings or fixed deposit, you will always have credit balances. Why? The bank will allow you to withdraw money only up to the point where you have a credit balance. So these are known as the normal balances. Now we have already learned the types of accounts and the types of balances. Now let us look at what is the normal balance for each of these types of accounts. It is part of double entry bookkeeping technique. The normal balances leads us to the accounting classification of an account. An account has either a credit balance or a debit balance, which is known as a normal balance. So if you have a credit balance, we normally show it with the abbreviation CR. 1,000 rupees CR means 1,000 rupees credit balance. If you have a 5,000 rupees DR means that means you have a 5,000 rupee debit balance, which means you have to pay the bank 5,000 rupees. So assets normally will have a debit balance. So now this is the starting point where we are trying to understand how the normal balance would be for each of these type of accounts. So we know now there are 5 types of account: assets, liabilities, capital or equity, income and expense. So they say assets will have a debit balance. Liabilities and equity normally will have a credit balance. Okay. So let's look at it one by one. Now, if you are having an asset account, it is said that normally it is a debit balance. Normally it is a debit balance. So when you put more and more debits into this account, what will happen? Your debit balance will go up. Your debit balance will go up. The moment you go and put more and more credits into this account, what will happen? Your debit balance will go down. Your debit balance will go down. So please remember, to an asset account, when you put a debit, your balance will increase. When you put a credit, it will decrease. It will decrease. These are very fundamentals you need to know. In an asset account, when you put more and more debits, the balance will increase. When you put more and more credits, it will decrease. Similar to that, it is the direct relationship when it comes to an expense account. Expense account is also generally known to have a normal balance, which is debit. So all expenses are debit, all assets are debit. Similar to the assets, when you put more and more debits into an asset account, expense account, your expense will increase. If you put more and more credits into an expense account, your expense will decrease. Very important. So these two have a direct relationship. That is why the concept is very important. Accounting cost concept and the prudence concept, all those are very important, where we say you should not mislead the asset and the expense. Why? Both are debit, and if you put a debit here instead of here, means your expenses will go up. And if you put a debit here instead of here, means your expenses will go down. So you have to be very careful when you are recording transaction in assets and expenses, because both will look like the same. Both will look like the same. Why? Both will have a normal balance of debit. And when you put more and more debits, means asset and the expense will increase. When you put more and more credits, the expense and the asset will decrease. Similar to this, we have the liabilities and the income or the revenue. Now, liabilities and revenue will normally have a credit balance. Like the assets and the expense, the liabilities and the income accounts will have a credit balance. So what does it mean? When you put more and more credits into this account, the liability balance or the income balance will increase. But when you put more and more debits into these accounts, your liabilities will go down or decrease and your income will go down. So it is very important that you differentiate the liability and the revenue. Why? If you go and put something which is supposed to go to the liability as a revenue, then you are understating your revenue. Similarly, if you put something into your revenue accounts which is supposed to go into the liability account, which means you are understating your liability. These differences have to be clearly understood, because in examination, you have to deal with all these transactions. So you should be in a position to understand what is a liability account, what is an income account, what is the type of balance that a liability will have, what is the type of balance an income account will have. These are very fundamental and important criteria. Lastly, we talk about equity. Equity means capital accounts, reserves, other capital accounts. So generally, equity accounts are also expected to have a credit balance. So likewise, in the case of liability and income, more and more credit means your equity account will go up. More and more debit means your equity will come down. So that is all about the normal balance. I hope it is very clear when it comes to the accounts, type of accounts, and the balances, all those I have explained in detail. Okay, so I hope you will have understood that, but there is a question from one of you saying that can you explain an example for internal events? So I told you, for example, let's take the example of a bank. Now banks are operating with branches, lot of branches. So when you operate with branches, it's obvious that you are serving your customers. So all transactions that you do with your customers are known as external transactions. Now the other side of the transaction is the internal transaction. So let's assume that there are two branches in a particular location which means say close by location, like let's say Boralla, and then you have another branch in let's say Rajagiriya. These two are close by. So there is a requirement for the Rajagiriya branch to honor a transaction of withdrawal of a customer, let's say for 50 million. But obviously the branch doesn't have that amount of cash. So what does the branch does is it calls the Boralla branch for them to get down some cash from Boralla branch. Yeah, Boralla branch has adequate cash. So which means now Boralla branch is going to send out cash to the Rajagiriya branch. Now this is an internal transaction. This is an internal transaction. But what is going to happen? It is going to have an impact on the accounting equation of Boralla branch and the Rajagiriya branch. Why? The Boralla branch cash position is going to go down and Rajagiriya branch cash position is going to go up. So there is a direct relationship when you look at these type of a transaction, which is an internal transaction. Likewise, you can have thousands of internal transactions. So, for example, when you look at a bank, the bank pays salaries to all of you. So you will have maintaining accounts with the bank, which is normally classified as staff account, and your salaries are credited to these accounts. So as far as the bank is concerned, this is an internal transaction where it pays salaries to its employees. But from a bank's perspective, even the employees are considered as an external party. I told you there could be a transaction between two entities. So even an employee is considered as a separate entity. So because of that, the transaction that you do with your employees also are considered as a transaction between two entities. So the transaction that you enter is between the two accounts within your bank itself. Okay, so that is, even though you consider it could be considered as an internal transaction, but it has a direct impact to your accounting equation. So are there any other questions? Okay, there is a question again asking about a contingent account. So let's look at another example. Let me give you another example. Let's say you are a company who is involved in road construction, and you have received a contract from the Road Development Authority. So RDA has given you the subcontract to construct a particular stretch of a road. Now you, being the road construction company, when you go and bid for this in the auction or for the tender, the Road Development Authority will request you to provide a guarantee, bank guarantee. Why is this guarantee is for? If you as a road construction company does not perform your contract, that is constructing this particular stretch of the road, if you don't perform the contract, then there is a loss to the Road Development Authority. Why? If they knew that you are not in a position to perform, they would have given it to somebody else. But looking at your strength and your past performances, they have given you this contract. But still, they don't want to take a risk of giving that contract to you, and because of that, they want you to bring a bank guarantee for some value. Let's say the guarantee value is 15 million. So what you do as the road construction company, you will go to your bank. Let's say you go to the ABC bank and request a bank guarantee to be given in the name of Road Development Authority. So if you don't perform the contract, ABC bank will have to pay that amount to the RDA or the Road Development Authority. So this is a tri-party contract now, which is happening between the Road Development Authority and the contractor. And the contractor is internally having another contract with the bank for the bank guarantee. Now look at this transaction from the point of view of the bank. Bank has a liability in the future if this contractor, who is a customer of your bank, if the contractor doesn't perform this contract. Let's say he performs the road construction, he starts with the road construction, halfway through he is unable to perform. Then there is a liability on the part of the bank to pay the road development authority. Now this is a contingency. This is a contingency. As far as the bank is concerned, the bank has a contingent liability. May or may not happen. We don't know. As long as your road construction company performs the transaction, the contract in full, there is no problem. The moment they withdraw or unable to perform the contract means the bank has an immediate liability to pay the road development. So whenever you issue a bank guarantee for that amount, you have to book in your accounting records as there is a contingent liability. So the accounts that you use to record these contingent liabilities are known as contingent accounts. But the most important part of the transaction is how the bank would record this in their books of accounts. Why? This doesn't have a monetary value because you are not going to pay money or going to receive at this point in time. It might happen or may not happen in the future. So what the bank will do is bank will record a contingent asset as well as a contingent liability in order to safeguard the balance of the accounting equation, because that is what we have right now learned, the double entry system. The double entry system gives you the understanding of all transactions have to be performed in confinement to the double entry principles so that you don't go and disturb the accounting equation. So you don't disturb the accounting equation means at any point in time your assets are equal to the liabilities and the equity. The same principle is applied to the contingent as well. Contingent also go on the same principle. There is another question. Can you explain the financial accounting versus management accounting? Below mentioned points. Subject to precise layouts and control. Yes. Now, even though the financial accounting and management accounting differs from its objective, which is financial accounting talks about the historical transactions, and you are providing that information to the outsiders or your stakeholders for them to understand, where you have a prescribed format. Yes, agreed. Because accounting standards provide you the prescribed format. But similar to that, when you are looking at the management accounting also, there is each company will have their own specific formats. Standard formats are there. It doesn't mean that they don't have, because the internal management might want the management accounting information to be produced in a certain format. So they will have their own formats to understand how the performance of the company internally. And if you go through the management accounting principles, there's so much of information that is available, or the frameworks that are available to use in terms of management accounting. So there is cash flow analysis, a lot of things are there. So all those are considered to be the standard templates or formats for management account reporting. We can't say that there is no specific format for you to do management accounting reporting. So do we have any other questions? Because I'm not going to start with this topic on prime entry books, because it might lead us less time. So we want to start it and do it continuously. But we'll commence after the holidays that we are going to have next week. You have another question. Second one, financial accounting equals generally produce and why is it? Yes. Financial accounting is provided, as I told you, the regulators, that is the central bank for banks and the stock exchange for banks and other companies, listed companies, they require it on a frequency because you need to provide adequate time to the preparers also for them to comply with these requirements. So that's why they have fixed timelines for them to understand to prepare the financial statements. Say, for example, financial accounting are prepared on annual and quarterly basis. But management accounting is at the discretion of the management. So you can prepare your financial statements or you can request for financial information at any time that you want. So there is no frequency is required for these management accounting because it is only for the purpose of internal. It is the internal purpose only you prepare the management account. So you don't go and produce it or publish it in the newspapers or maybe in your website for you to understand, for outsiders to understand what is your company is doing. So there is no necessity for you to make available the management accounting information to the public. Any other questions? So since there are no questions, I will stop at this point and I wish you all